Well, Ezra, cheers. Welcome to the Financial Shepherd Happy Hour. It's good to have you on this side of the camera.
Yeah, I'm a little nervous.
Yeah.
I'm more than a little nervous, actually, especially with the day we just went through.
Well, it definitely happened.
Yes, it did.
We were talking yesterday, and you asked me what's the probability of inflation and numbers coming in hot. And I think I told you it's probably about 70% chance of it coming in hot, maybe 30%, right at about where economists expected it. And if we do get that, probably going to see a significant sell-off, and that's exactly what happened.
That is precisely what happened. So no better way to react to that than to pour one out and talk about it with everyone, fans of the show, anyone who stumbles on this. Yeah. And I think pre-camera, we just agreed that this is now going to be a Friday happening.
Yeah, and after this, start of the year, including the data that we got today, it's appropriate that it's actually raining outside.
Yeah, thank God, right?
And you definitely need to have a little beer after the start to the year that we've seen here in 2022.
Yeah, I wish I could pour this beer out, but I needed it all for my mouth for my emotional state.
Well, no doubt. Well, the reason why we do these shows, the podcast, why I send out newsletters, why we do all the things that we do, is not just something that I love to do and I have a lot of fun doing it, and you're awesome on the editing side, behind the scene camera. We've got a lot of great feedback from all the content that we put out there, and clients love it. People that don't know me, will say, hey, this is awesome, really appreciate it. I just want to give people, the real information, what you actually need to know. That way you can control your temperament and emotions, because they're very, very high right now. And I've done a lot of research and preparation for this happy hour, which is unusual. Usually I'm not doing any research during a happy hour, but did some today, and we got some good stuff to talk about. So hopefully it'll put things in perspective for folks as you go into the weekend. I think a lot of people with this sort of data, the reason why I didn't pull the trigger on buying anything for clients today is simply because I think people are going to digest this. They're probably going to stew over it, this weekend. And if they're not doing, the data research that we do on a regular basis, they're probably going to wake up on Monday morning and potentially make a knee-jerk reaction type of decision and start to sell stuff. And the data here, indicates that Americans and investors that invest in America around the world are having this emotional reaction, and it's absolutely not going to help them in the long run. So,
no, understandable, yet not the thing to have base your actions. Rather than hit that sell button, crack a cold one of your choice. Even a little LaCroix is nice.
Yeah.
If you're not interested in the beer. So yeah, I'm looking forward to this happy hour as well, because the state of the portfolio certainly drove me to come over here and crack one with you. Yeah. But it's definitely not a reason to hit the sell button. So I'm looking for the data to help my temperament calm down. Yeah. Maybe even through Monday. Like you said, I don't want to stew over it on the weekend and make a rash decision.
Yep. So we'll get into some topics here, but I think this was a great idea that you had. I know that you don't manage money for a living. I know you don't work with...
I spend it a lot. I spend a lot of it.
But the content creation and this idea I thought was excellent. We're sitting actually on my back porch right now. We thought about doing this, on site at a local brewery or distillery or something like that, which may actually happen.
Yeah. Plans are in the works.
Haven't found the perfect place yet, but we'll definitely do this every Friday.
Yeah.
And I look forward to doing this with you, man.
Me too. And I want to tell everybody watching that from the Fridays post-tense, Friday here on out, we're going to be going live on our YouTube channel. So get all your questions of the week from the stock market, your personal finance questions ready for Joshua. And you can tune in every Fridays at 4 and hop in that chat. And hopefully we can get a good conversation with everybody out there, celebrate the highs, but also talk each other through the lows so that we don't make some rash decisions.
Yeah, and it's nice to have you here. Again, I know that this isn't your profession, but it would be kind of odd to do a happy hour sitting in front of a camera on my back deck, drinking a beer, talking to myself, I don't know how my neighbors might, look at that, but that's okay.
Well, it wouldn't be any different from any other Friday night.
No doubt. So a couple of things I wanted to I guess, start out with the conversation. Everybody's asking the big question, like, where can we get some relief in the market? Where is there a place to maybe hide out? Where is there an opportunity for me to just lose less money than the overall market? And we always talk about temperament and asset allocation. I'm going to start with the asset allocation part of the conversation today.
All right.
Because I got some awesome data here from, that big data energy we've been talking about.
Bringing the big data energy, always.
State Street, all right? So State Street came out with this data. It is awesome. And there's a whole bunch of stuff I could talk about. When I got my hands on this stuff, I literally was like a kid on Christmas morning. Like, I think this is awesome. I can't believe that this is actually free and available for people to do research and use this information to their benefit.
I mean, if you're going to free fall without a parachute, someone's got to find it fun, right?
No doubt about that. So we talk about asset allocation all the time. And why is asset allocation important for those that may be watching this for the very first time? We believe at Shepherd Wealth Management, investors in general are trying to solve two major issues at the end of the day. One is, how can I get consistent performance out of my investments so I can achieve my goals long term? And also, how can I make sure I don't take on too much risk while I go about my investing career and trying to accomplish those goals? And Mr. Harry Markowitz, back in 1952, came out with this concept called modern portfolio theory. He later won an economic Nobel Prize for it. They still teach it in every business school around the world. And basically, in a nutshell, what he was able to prove is by controlling the asset allocation, which is just a fancy way of saying this is how much of my money is invested in stocks, bonds, and cash. That asset allocation explains 94% of your performance over time, and it certainly explains all the risk that you're taking to achieve that. So the great news for investors out there is there's really only two things that you can control when it comes to investing for the long term. Clearly, we cannot control interest rates. We can't control what politicians are going to do. We can't control geopolitical events. Like, we can sit here from now until next Friday just talking about stuff that you cannot control when you're investing, right? But you can for sure control your temperament, right? You can control your asset allocation. So with that introduction to asset allocation and modern portfolio theory, here's the data from State Street. I'm going to start with a conservative portfolio. So 20% stock exposure and 80% bonds. Okay.
Bonds.
80% bonds, 20% stocks. That's the asset allocation. Thus far this year, in 2022, and this is as of May 18th, 2022, this is where the data lies.
All right.
That 20% stock, 80% bond asset allocation is down 12% year to date. Historically, the worst drawdown with that asset allocation was 5%. So you're more than double the drawdown from the historical average for pretty much the most conservative asset allocation you can have. Why is that, do you ask? I can already feel a question, right? Viewers probably ask the same question.
That was my question. Why? Why is that?
So obviously the stock market is down. NASDAQ's down more than 20%. S&P's down, I think, around 17% at the moment here as of the end of today. The Wilshire 5000 index is down near bear market territory. So obviously, I think everybody understands that the stock part of this asset allocation is down across the board, right? Bonds, however, usually are the place to hide out, to see some safety, to see some sort of positive return, generally speaking. A year like 2008 was the last real recession, if you throw out the pandemic,
right.
March 20, right? That was, an unpredictable event.
And we kind of just ran right into what we're in now with it anyway. So
exactly. But 2008 was really the last real recession. Right? Yeah. Terrible. It was the worst recession since the Great Depression of 1929. But bonds were actually positive, like 5%. And if you were in certain types of bonds, like long-term government bonds, because the Fed dropped rates, I mean, those were up nearly 20% or so. So usually you get some safety and some positive results when stocks are doing bad. Bonds typically do well in general. But this year, bonds are down 10%. Year to date. And if you have 80% of your money, invested in bonds, this is basically the most conservative asset allocation that we would use for a client at Fidelity and TD Ameritrade.
Okay, yeah.
And it's still true for a lot of financial planners. They'll probably always have, even for the most conservative investor out there, some percentage in stocks. And they'll probably have something like 80% in different types of fixed income investments. But year to date, that is down 12%. That is staggering, okay? But get this though, when you compare that to a typical 60% stock, 40% bonds, which is the classic asset allocation for a retiree. Like financial planners like myself have been recommending this asset allocation for somebody that's retired for decades, okay? That's down 15% year to date. 60% stocks, 40% bonds, down 15% year to date. And I just told you that a 20% stock exposure, 80% bonds is down 12%. I mean, you're taking on substantially less risk, and you almost performed as bad as somebody with 3 times the stock exposure.
Yeah.
It's nuts, right?
It's unexpected, almost as unexpected as would be someone with that 80% allocation in bonds not living long enough to see the Bush administration, because I feel like that's my grandmother's stock market.
No doubt. And then if you go even
conservative thing,
you go out even further, you got the 80% stock, the exact opposite, right? 80% stocks, 20% bonds. That's down 16% year to date. I mean, this is only a 4% difference and a 4x difference in risk exposure to the stock market. So this is by far one of the oddest years I've ever seen as a financial professional for over a decade now. And obviously the data is showing that investors are having a difficult time dealing with this. Outflows for mutual funds and ETFs across the board are at historic lows. The investor sentiment survey, which came out today, with the inflation data that we got this morning before the market opened. So the University of Michigan does this investor sentiment survey about how people are feeling about the market. And they were expecting a number of 59. Last month, or the last time they did the survey here recently, it was like 58.2, so still relatively low, but they expect it to improve a little bit. It came in at 50. The last time it was at 50 was 2008, which was the worst thing that's happened to the stock market since the Great Depression of 1929 from a year standpoint. So surveys are telling the Wall Street analysts that investors, regardless, even though earnings have been really good, relatively speaking, with all this stuff going on, it doesn't matter if you post a good report on your earnings call. It just does not matter, because investors are worried about $5 per gallon gas here in Kentucky and Cincinnati area. You got food inflation, which is at historically high levels, and in some places around the world there will be a famine later on this year. Here in the United States, it's just going to cost us more money. So sentiment is super low, but for the long-term investor with the right game plan, which we'll talk about here in a minute, is absolutely an opportunity to take advantage of, because bad times do not last forever.
They don't. It's hard to watch them go down, though, especially with 2008 being pretty much in, I think, for the most folks who are old enough to watch this and be interested in investment, in their lifetime, at least if they didn't participate in that market, they're going to have heard about it and witnessed it. So with these numbers, this investor sentiment number looking the same as it did back in 2008, how much of that do you think is a portend that it's going to be a similar drawdown, or do you think that's just because only 14 years later we had the pandemic, got this horrible situation in Ukraine that not only is ruining lives in Europe, Eastern Europe, but it's also have economic repercussions across the planet?
No doubt.
Do you think that's what's causing this number to be lower than they expected by 10%? Or
yeah, I mean, you got to think about it. A lot of the people that are taking this survey are young enough to not know what 1980 inflation was like, right? They didn't know, they weren't around, or they were so young that it didn't matter, right?
Yeah.
Toddlers, whatnot. Even for folks that are our parents' age, that were around, that probably were investing during that time, it's been a long time. Right? I mean, that's a ways back, 1980. So 2008 comparison to what's going on now is different simply because in 2008, a whole bunch of bankers, which is obviously a huge backbone of the United States economy, it's not backed by the gold standard anymore. It's backed by the full faith and trust of the U.S. economy, and banks are obviously where people tend to park some cash and also make some investments. And when they find out that, a lot of bankers that had really good reputations were actually doing a lot of nefarious things, it caused a ton of faith to just be depleted, and also a lot of large companies went bankrupt as well, or got acquired by larger institutions. So this time, it's not banks, it's not the housing market, it truly is the war in Ukraine, right? That's keeping energy prices high, which is affecting every sector of the market. You also have this food shortage, fertilizer shortage caused by a lot of things going on in Ukraine. Energy prices were already going to be pretty high coming into this year anyway. And then China said, we're going to lock everybody down. And then, of course, you got that war that kind of exacerbated everything as well. So, and the Fed told everybody coming into this year that we're going to raise interest rates, which obviously slows down the economy as well and affects stock prices, of course. So I can't make a direct correlation comparison to 2008 and what's going on now, but there's just so many bad things that investors are seeing on a regular basis, and there really isn't much of anything that the politicians can do to solve this in the short term. And it's going to take the Fed a while of raising rates consistently over the coming months to get a handle on this, because just because they raise rates doesn't mean it instantly affects the inflation data.
Right.
It takes some time.
Yeah, I mean, we're even seeing that with gas. Biden released all those barrels of oil to try to alleviate the price, and it's done nothing but go up.
Yeah, it's just the supply and demand dislocation, right? I mean, everybody has to purchase it. Business have to purchase it to ship their products and goods, and it is it's an issue that we're trying to solve for right now. But frankly, it's just going to take more time than the end of June to solve some of these things. So
we're laughing because it hurts.
Yeah, no doubt about it. So what can we do? Well, one of the things that is positive, the only thing actually that is positive, if you look at all the sectors of the market, are commodities, right? Energy related investments, natural gas related investments. So what we did for clients at Shepherd Wealth Management at the beginning of this year, or maybe the end of December for some folks, is we talked through a lot of this stuff. Now, obviously, I could never have predicted a war in Ukraine, which again kind of exacerbated everything.
Right.
But we knew the Fed was going to raise rates, so that's bad for bonds. So we took almost everybody out of bonds, and those that wanted to keep some bond exposure was for very specific reasons. But they at least knew the information going into this year that, hey, this is likely going to happen to the fixed income market. So we talked through a lot of that. So we got almost everybody out of fixed income. Those that stayed knew exactly what was likely to take place. And what we also did is we removed people from international positions. The international market is down almost 20%, and it's almost a certainty that Europe's going to have a recession this year. So
they may not be the only one.
It may not be the only one. It might happen here in the United States. That's not my base case.
No, I mean, we're hoping, obviously, that doesn't.
And it's not just because I hope it doesn't happen. It's because we have historically low unemployment, and it just is I've never seen a data point in history where we've had unemployment rate at 3.6 and there's a recession that actually happens.
Yeah.
However, the Fed has never in its history been able to do what they're calling a soft landing. When they're raising rates and trying to slow the economy, they've never been able to pull that off. Now they're trying to do that, and they have a very, very small spot to land this plane, and it's likely there's going to be a lot of turbulence more than anything. However, we did some things for clients that help their performance, so they're feeling less pain, taking them again out of almost everybody out of fixed income, taking everybody out of international. And we parked a lot of that money into energy positions. Now, in hindsight, perfect hindsight, sitting here, almost 6 months into the year, I wish I would have added a whole lot more to energy for clients, for sure. Now, what we're able to do is, again, control the asset allocation. So at some point in time coming up here in the next few months, we're going to do quarterly reviews in July, sometime after July 4th. And we're going to talk about taking some profits from the energy positions that we've been in. Healthcare sector is doing relatively okay, so we have some positive results there. And defense companies are also doing relatively okay. Obviously, with the war in Ukraine, companies like Lockheed Martin, are going to benefit from things like that. So, having a really well diversified portfolio, everybody's heard about that. Not having all of your eggs in one basket, of course, but we can be selective about where we're going to add exposure and how much exposure we're adding it to. Again, we're controlling the asset allocation, and we're going to take those profits, we're going to add them to all the other sectors in the market that have really not performed well at all, and technology's been their greatest laggard. It happens to be the largest sector of the market as well, and it led the way for all the positive returns that we saw 3 years previously. I think a lot of people are starting to forget that we had 3 straight years of double-digit returns in the S&P. A lot of that was led with technology sector.
Right.
And, you know, this is just an inevitable event. These types of things are certainly going to happen, but when we do eventually have the recovery, and I think that we'll start to see signs of a recovery here as we get to, you know, the fall, October, November, we'll get through the midterm election. Hopefully a lot of these things will start to be coming down from an inflation standpoint. The Federal Reserve will raise its rates a few more times leading up to that. So I think we'll start to receive some sort of recovery later on this year. But by doing what we're talking about doing here, shifting gains into other positions that have underperformed, well, it's likely that those positions that have underperformed, such as technology and other sectors, of course, all the other sectors, we should benefit from that greatly. So that's how we're approaching this market. It's not a traditional way to do things, but this is definitely not a traditional market right now.
No, not a traditional market. I think it was a couple episodes back I heard you mention that even Charlie Munger,
yeah.
Sorry, was saying, you know, if you're not confused right now, you're not paying attention.
Yeah, I mean,
everybody's kind of in that boat. It's not a time for, you know, anyone to wax like they know what's happening.
Exactly.
They probably don't. If
no,
they do.
no. I mean, a guy like Charlie Munger, who's in his late 90s, still sharp as a tack. He's been around the block a few times from an investment standpoint, and him to say that, you know, hopefully will put some context to the situation here. However, like we've talked about in other podcasts that we've done, is that Warren Buffett, Charlie Munger, his team there at Berkshire Hathaway, they've deployed, I think it was about $150 billion worth of capital here.
Yeah.
Over the first, you know, not even full 6 months in the calendar year, and they still have plenty more capital to put to work.
Right.
But the great news is, like we talked about earlier, these bad times, they don't last forever. And when you start to actually digest the information and look at it from a different perspective, as crazy as it sounds, we've kind of used energy and some defensive sectors like healthcare, defense companies like a Lockheed Martin, to kind of act like bonds. As weird as that might sound, that's exactly what we were expecting. Again, I wish I would have added more to energy, but that's what we're doing. And the cool part about that, obviously we're doing better than all the major averages because of the decisions that we made with clients. Everybody's down. Let's not, you know, mix words here. Portfolio is down, but it's just down a lot less than a lot of the other major averages. But people just cannot get that. You know, if you go to a bank, if you go to the companies I used to work for, these large institutions, they take the individual advisor risk out of the equation. So what I mean by that, and don't get me wrong, I love Fidelity, TD Ameritrade. They're a great place to work. I wouldn't be here without all the training and experience that I had there. Still got a lot of friends there. I got nothing but respect for those institutions, but they're so large, they have to take measures to avoid things like lawsuits, and they're, you know, inevitably going to get them anyway because they're such a large institution. But they want to remove the individual advisor risk. And what I mean by that, let's say me and you, Ez, were both working at one of these large institutions, and you're also a financial planner here for a second, all right? I'm going to give you that designation.
All right.
All right. So we're in offices. I got an office. Your office is right next to mine.
What? How many windows?
At least 3. Not the best view, but it's cool. So I have a client walk in, husband and wife.
Okay.
And you have a husband and wife walk in the same day, let's say, and profile is very, very similar.
So we met on Tinder.
Well, I don't know.
Financial profile. My bad.
Yeah.
Well, that didn't mean anything.
Exactly. But if you have those clients in there and you build a portfolio, and I build a portfolio for them, and we think it's the right fit for them, we actually have the same asset allocation for these clients.
Okay.
But the positions I selected had awesome performance, and the positions you selected were terrible, right? And you got to keep in mind, they're the same client profile. They scored the same, like when they fill out those suitability questions, what's your risk tolerance, goals for this money, etc. And they both scored a 60, let's say. Right? We gave them the same asset allocation, but I got to pick the investments. They worked out. You picked some investments, didn't work out. Well, that would definitely open up those large companies like a Fidelity, like a TD Ameritrade to a lawsuit, right? Very similar customer profiles. and I just happened to pick better investments than you did for the exact same asset allocation.
Right.
So they take that out of the hands. So when we would go through this process of having these conversations with clients, yeah, we got them the right asset allocation, no doubt about it. But what that always meant was, because we didn't have the ability to control hardly anything about what we were actually investing in, we knew the asset allocation was right, which again explains 94% of performance. It still got the job done. But what it also meant was investors were always going to have X percentage in bonds. They were always going to have X percent international. They were always going to have X percent in different sectors of the US stock market, right? And when you go through years like this, like we just talked about these 3 different asset allocations, because you're holding those at all times,
Right.
you know, it's just not, it doesn't make logical sense to hold a lot of fixed income when rates are rising. The Fed told you a year in advance that we're going to jack up rates because we got to slow the economy down and try to dampen inflation. The whole globe, Europe, Asia, all the banks around the world are also raising interest rates. There's not a bond on this planet that's going to make any money this year, for sure. And then you throw in things like the war in Ukraine, which again I couldn't have predicted, but that also makes the international market extremely volatile, even in a lot of cases more volatile than what's going on here in the United States. So having the ability as a registered investment advisory firm at Shepherd Wealth Management to do these types of things for clients, it's the exact same conversation I have with folks. We're just able to take a more logical, what I would call more tactical approach to modern portfolio theory and helping them control risk at the same time with their asset allocation. So even though this has been a full year of Shepherd Wealth Management being in business, in hindsight, I wish I would have started this company when the market was moving up to the right for 3 straight years. This is the whole reason why I wanted to do this, is so I can do things that I thought were in the best interest of clients. And although it's been a crazy, volatile year so far, I couldn't be happier with a lot of things that we've been able to do. And I think that in the long run, right, markets are positive 75% of the time. We'll be down 25% of the time. And by doing some of these tactical things, I think clients will be pretty pleased.
I think they will too.
Ez, this was an absolute blast for our first happy hour, my friend. I think we're right up on the time.
Yeah, it's definitely time for another.
Yeah, cheers. And we'll see you all back next Friday. Take care.